Are you kidding me? Are you kidding me? Vanguard money market is paying 4.71 in the 7-day SEC yield. Come here. Pablo's all jumpy. Come here. You can come here. I don't know what to tell you. All right, he wants to go outside. So come with me, my friends. Come with me. Vanguard money market. I just got off the horn of this guy in Alabama who's just crushing. Dude, Alabama is where it's at. He lives in Baldwin County, paying $700 a month, a year in property tax on a $350,000 property or something like that. Ooh, it's bright. So check this out. Anyway, Baldwin County is South Alabama. And then Annette, one of the contributors to the show here, has sent back some data on other Alabama counties. Maybe I'll just do a video on that solely, but specifically to that. But anyway, let's check this out. 7-day SEC yield on the Vanguard money market account. Man, that's bright. Freaking 4.71%, dudes. 4.71. You're getting paid 4.71 to sit there and do nothing and just freaking collect your shekels. Do you know how long it's been since we've seen this kind of returns on safe money? But it's not safe. It's not FDIC insured. It's a money market, dude. Has Vanguard money markets ever broke the bank, broke the buck? No. Could they? I suppose. I don't think so. Remember, I think it was a federated money market back in 2009 that broke the bank. I keep saying break the bank. Broke the buck, which means it dropped below $1. I mean, anything could happen. But Vanguard, Treasuries, I highly suspect that's not likely. So it's not FDIC insured. It's SIPC. SIPC is for fraud. SIPC isn't because the bank went under or anything like that. So, but remember, what is the foundation of the money market? It's the Treasury Bonds it has, or in this case, Treasury Bills. Dude, you're sitting on the side. So this guy's about ready to retire. He's like, should I put it like a retirement fund or a life cycle fund or something? No, put it in the freaking money market. You're sitting tight. You're getting 4.71 to sit idle. I said, even if you kept, the drawback is we don't know what the rates are going to be in the future. Man, I 100% get that. I get that. So if rates go down, what is the reason rates go down? All right, come here. Why would the rates go down? Well, the rates would go down because Pablo wants to. You want to say hello? Yeah. Right. The rates would go down simply because the economy is going south, i.e. recession. All right. So that means the Fed lowers the short-term rates, the Fed funds rate. What does that mean for stocks, generally speaking, in recessionary times? Now, we could say the recession has already been predicted because we literally had a recession last year, and that's just a fact. We had two consecutive quarters of negative growth. Everyone says, but it's not a true recession. Well, according to the data, it was, but whatever. So maybe that's already been priced into the market's already reflected that recession. I don't know, man. I don't know in those. But the Fed funds rate is, 4 3/4 right now. So either, again, as I said before, here's the Fed funds rate. Here are the long-term rates. Long-term, short-term, long-term, that's inverted. Significantly inverted. The 10-year Treasury right now is at 3.5. It's 120 basis points below the Fed funds rate. It's insanity. So what's going to happen? Fed funds rate, long-term. Fed funds rate, long-term. Long-term, I'm talking 10-year Treasury. 10-year Treasury either has to jump well above the Fed funds rate to get back to historical yield curves, or the Fed funds rate is going to have to drop. What is more likely to happen? You want to take a guess? The Fed funds rate is more likely to drop. Why? Because recession is kicking in. Why would a recession kick in? Because the economy's on thin ice. What typically happens to markets when the recession kicks in? They go down. Can I guarantee that? No. We only had a 20% decline last year. That's no big deal. I mean, it's a bear market, but it's a short-lived bear market. NASDAQ stocks are back into what looks like a bull market, but is that a dead cat bounce? I don't know. But generally speaking, when the Fed is lowering rates, it's because the economic output of the GDP is not good. It's recessionary, or they want to stop it, or whatever. And I don't think the Fed controls the economic output anyway. Don't get me wrong. But at the end of the day, the reason I think it's kind of like CO2 and temperature. Everyone thinks CO2 leads to temperature. No, temperature leads to CO2 parts per million. I mean, it's just idiotic how many people think we have this little. We can turn a switch If we increase the CO2, that inherently increases the temperature. That's what they think. We do this, thus that. It's idiotic science. This is the scientists are so damn arrogant. The same kind of thing here. The Fed funds. If we increase the interest rates, the GDP starts slowing down. Then we decrease the interest rates, the GDP starts going up. We have this little gauge here, little valve that we can switch on and off. And a knob. It's so freaking stupid, man. It drives you up the wall because everyone thinks, again, with CO2 and temperature, with interest rates and economic output, it's dumb. Anyway, the point being is, so the Fed says, oh my goodness, we're in a recession. We let our way into recession by raising the interest rate so high. So how do we deal with the said recession? We lower rates. Stock market, usually when recessions come, they don't take too kindly to recessions. They fall. And so now you got all this money sitting on a 4.71 money market account. The recession's here. The stocks are falling. The Fed's lowering. And you go, what do? You take your cash that's sitting idle on the side and you go on in there. And you buy up some stocks at cheap. So this guy I just talked to, he was able to buy his house in a foreclosed house in 2008 for $150,000 discount. Why? Because he had the cash. He had the cash. I don't remember what the 10-year what the money market was doing back in 2008. I think it was like 3, but now you get 4.71. So let's just say, and he said, well, Josh, your boy Dustin Tibbetts over at Jazz says, don't get out of the market. I'm not telling you to get out of the market. I'm just saying, let's just say my man just retires. He parks everything in the Vanguard money market account for the time being, which he should. And he has some CDs too. All right, let's just say the markets go up 10%. So he's getting 4.71. The market goes up 10. And again, if the markets jump up 10, most likely it's because the economy is looking pretty good, and most likely they're not going to lower. So he's still getting the Fed funds rate at 4.71. Markets jump up 10. Did he miss out on the market? Yeah, he missed out on 10%. But what did he get in return? He still got 4.71. So it's not a significant opportunity cost. Will the market jump up 30%? I don't see that happening, but I guess it could happen. Where's the proof of that happening, though? What would that be based on? Earnings growth? Are you kidding me? So let's just say, all right, so now the market jumps up 30%. Like, man, I missed out. FOMO, fear of missing out. You still got 4.7, dude. If the market goes up that much, that usually means we got serious economic output, which means the Fed might even still raise even more because inflation is so bad. I tell you, I just hope people take advantage of the short-term money that we got. This is the first time in a long. It's so good to be able to say money market accounts look good right now. I haven't been able to say that for 15. Actually, what was the 1 month Treasury bills 3% back in 2008. We go 3. Go all the way down to 11 basis points. Look at that. Look at that. So start off at 3 and went down to 0 by the end of 2008. Let's do 2007. 4.79, 4.84, 2007. I saw 5, 5.2, 5.24, and then it started going back down. So basically 5.25 in 2007, and then it started dropping significantly. When I first started in the business, 1998, let's say it's 5%, I think, if memory serves. Yeah, for 3-month bonds, or T-bills, 3-month bills, you have 5.3. Let's go down. That's freaking hot, dude. I can get some sun on my beautiful pale skin, getting that vitamin D. Look at that, 4.2. I just don't know how. Look at that, 6 months, 10-year Treasury, 3.79. As of right now, it's at 3.57. Look at that. Don't overlook your opportunities. Short-term, safe money. All right, love your thoughts. We'll see you.